Gold at $4,220 an ounce feels like a whisper in a hurricane, but it's screaming undervaluation if you know where to listen. The 10th of December, 2025 today. The Fed just dropped its third rate cut of the year, a tentative 0.25% slice that shaved the federal funds rate to 3.5 to 3.75%, but with Powell's hawkish undertones echoing like a trap snapping shut. Markets priced in an 87% chance beforehand. Yet the rhetoric nodding to sticky inflation a full point above the 2% target hinted at only 2 more cuts in 2026, not the dovish flood Wall Street craved. The dollar index? It buckled to 99.2, a 7% year-to-date hemorrhage, its weakest 5-week low since the summer slump. And gold? It didn't flinch. It surged to $4,220, up 55% year-to-date, brushing all-time highs while silver shattered $61 in sympathy. But here's what nailed me to my chair this morning. Scrolling through fresh JPMorgan notes with the market still reeling. Their analysts aren't whispering $4,500 anymore. They're forecasting a $5,000 surge by Q4 2026, averaging $4,753 for the year, driven by central bank hordes averaging 566 tons quarterly and investor flight from fiat fragility. Why undervalued? Because adjusted for inflation since 1980's peak, gold's buying power is a shadow down 40% in real terms, while global debt balloons past $350 trillion, central banks gobble 1,000 tons yearly, and geopolitical fault lines from Ukraine to Taiwan crack wider. My theory, forged from dissecting COMEX flows and Fed transcripts over sleepless months, is that this isn't a rally. It's stage 3 of a 4-stage trap that's ensnared economies from Nixon's gold shock to the 2008 meltdown. The Fed cut was the bait, luring yields lower and dollars weaker, but the hawkish trap snaps back. Inflation reignites, forcing pause or reversal, supercharging gold as the ultimate hedge. JPM's $5,000 warning isn't hype, it's math meeting mania, and at $4,220, gold's the most undervalued asset in a portfolio near you. The window to reposition? It's creaking shut amid this Fed-induced panic, but you still hold the latch if you act before stage 4 detonates, prices parabolic. Before we unravel this trap thread by thread, let me lay it bare. I'm not a financial advisor, and nothing here constitutes financial advice. This is strictly educational analysis pulled from public sources like JPMorgan research, COMEX reports, and Bloomberg data. I've crunched these numbers, chased the patterns, and what surfaces isn't speculation, it's a merciless cycle that's minted and mauled fortunes for generations. To pierce the veil on why gold screams undervalued at $4,220 amid JPM's $5,000 clarion and the Fed's insidious trap, we need the blueprint. A 4-stage pattern that's as old as markets themselves, a relentless engine turning complacency into catastrophe, surge into squeeze, and recognition into raw eruption. This isn't armchair theory, it's battle-tested across gold's bloodied history, from ancient coinages to modern manias, and today it's grinding gears louder than ever with the dollar's fresh bruise. Stage 1 is complacency, the seductive setup where abundance blinds the mighty. Post-1971, after Nixon slammed the gold window and unleashed fiat dollars untethered from metal, gold languished at $35 an ounce for a decade peanuts in inflation's furnace. Central banks dumped reserves. Paper proxies like futures and GLD ETFs mushroomed, dwarfing physical by 50 to 100 times in notional claims. Open interest swelled to absurd multiples of vaulted bars, pinning prices low as everyone nodded along. Infinite supply, zero worry. Debt printers hummed quietly. Global M2 money supply exploding from 10 trillion in 2000 to over 100 trillion today. Yet gold slumbered, undervalued against the debasement deluge. It's the era of trust in the system, where JPMorgan's vaults brim but markets yawn, complacency coiling the spring. Stage 2 is expansion, the insidious surge where gaps yawn but warnings whisper. Enter 2008. Financial Armageddon, Lehman vaporized, central banks unleashing 30 trillion in liquidity, lifelines the Fed's balance sheet alone quadrupled to 8 trillion. Yields cratered, dollars diluted, but gold? It clawed from $720 in October 2008 to $1,923 by 2011, a 167% roar, yet still undervalued versus the money tsunami. Industrial whispers grew. electronics, medicine, even solar edging in, but monetary flight dominated as savers fled fiat to hard yellow. Central banks flipped from sellers to subtle buyers, amassing 500 tons yearly by 2015, while COMEX eligible gold ballooned to 500 million ounces, paper claims outstripping physical 200-fold. Prices probed $1,900 in 2011, then retreated under suppression shorts from banks like JPM, capping the upside, derivatives flooding to mimic supply. Expansion widened the chasm. Debt to GDP ratios from 250% in 2008 to 350% now. Inflation masked by CPI tweaks, gold's real yield allure buried under zero-rate fog. Yet the surge built, undervaluation festering as policymakers patted backs, blind to the trap. Stage 3 is the break, the squeeze where illusions shatter and panic prickles. This is our now, crystallized in today's Fed cut and dollar dip to 99 recognition dawning that supply chains for gold mining lag demand by years, central banks hoarding 1,200 tons in 2025 alone, up 20% from 2024. COMEX registered gold, down 25% YTD to under 10 million ounces, eligible at 500 million, but delivery strains mounting as lease rates spiked to 2% annualized. Backwardation flickers spot premiums, edging futures as ETFs like GLD see inflows rivaling 2020's frenzy, 300 tons quarterly. Geopolitics amplifies. BRICS nations, holding 20% of global reserves, eye gold-backed units to dent dollar hegemony, while U.S. debt at 130% GDP fuels fiscal trap fears. The Fed's hawkish tilt today? That's the snare cuts lure easing, but inflation's 1% overhang pauses policy. Yields rebound, dollar claws back, trapping gold in volatility that purges weak hands before breakout. JPM sees it. Their $5,000 call hinges on this squeeze, investor demand hitting 566 tons quarterly in 2026 as real yields flirt negative. Undervaluation peaks here, gold's 55% YTD, pales against money supply's 300% bloat since 2008. Historical inflation-adjusted peaks at $2,500, today's dollars screaming bargain at $4,220. Stage 4 is eruption, the trap's jaws clamping in parabolic fury. Prices don't inch. They gap $5,000 by Q, 2026 per JPM, averaging $4,753 yearly, potentially $6,000 by 2028, as central banks average 800 tons buys. Trading halts at COMEX. Delivery defaults cascade, premiums balloon 20 to 40% over spot as physical vanishes into sovereign vaults. Governments hoard for currency wars, industries bid for electronics purity, monetary refugees overwhelm mints 2020's 28% premium on bars, multiply by 5 in full panic. The Fed trap detonates it. Hawkish pause reignites inflation, forcing deeper cuts later. Dollar craters further. Gold revalues against debased fiat. This pattern's ironclad never failed, always transfers wealth from paper chasers to physical holders. With JPM's warning ringing and the dollar's 99 bruise fresh, gold at 4,220 isn't priced, it's primed. But to grasp the undervaluation's depth, let's journey back to the crucibles that forged this beast. Nixon's 1,971 gold shock remains the primal scar, Stage 1's complacency exploding into eternity's trap. Bretton Woods teetered, dollars flooded post-war, redeemable for gold at $35 an ounce, but foreign banks, France, Germany, demanded bars for their greenbacks, draining Fort Knox from 20,000 tons to 8,000. Stage 1 complacency ruled. U.S. Printed with abandon, assuming infinite trust in fiat proxies. Gold dismissed as relic, while inflation simmered 5% yearly. Expansion crept in the 1,960 seconds. Vietnam deficits, Great Society, spending ballooning 150%, but the break hit the 15th of August, 1971. Nixon's Sunday night bombshell. Gold window closed. Convertibility suspended indefinitely, unleashing pure fiat. Stage 3, recognition ravaged markets. Dollar plunged 10% overnight. Gold freed to $38, then $70 by 1973 as inflation doubled to 11%. Everyone realized no metal backing meant endless dilution. Foreign holders dumping treasuries for bullion. Stage 4 eruption scorched the decade. Gold from $35 to $850 by 1980. A 2,300% inferno that bankrupted speculators but minted early physical owners like the Rothschilds anew. The trap? Fed hikes to 20% under Volcker crushed inflation but lagged the debasement. Gold's surge outpacing stocks 1-0-1. Lesson etched. Sever physical from money, and eruption follows. Undervaluation, the prelude to revaluation. Fast forward to 2008's GFC, the modern echo where expansion's debt dragon devoured itself. Stage 1 lingered into the aughts. Gold at $300. ETFs like GLD launching 2004, diluting mystique with paper ease. Central banks still net sellers dumping 400 tons yearly. Complacency peaked, housing bubble, derivatives quadrillion notional, Fed funds at 1% fueling leverage orgy. Then Stage 2 surged. Subprime cracked. Lehman imploded the 15th of September 2008. Credit froze global trade. Gold clawed from $720 October 2008 amid 30 trillion liquidity tsunami. But suppression held prices pinned under 1,000 as JPM and peers shorted futures, open interest exploding 300%. Stage 3 broke wide in 2009. Quantitative easing dawned. Balance sheets quintupled. Dollar index cratered 15%. Recognition dawned that bailouts bred moral hazard. Inflation lurked. Gold pierced 1,000, then 1,000. 900 by September 2011, a 167% tier as Europeans fled Eurozone woes to bullion. COMEX deliveries spiked 50%. The trap snapped in Stage 4. 2011 peak at $1,923. Then volatility trap Fed taper tantrum 2013 yanked yields. Gold plunged 45% to $1,050 by 2015. Purging leveraged longs while physical holders like Soros doubled down. Yet undervaluation deepened. From 1,923 peak, inflation adjusted to 2,500 today's dollars, gold slumbered till 2020's COVID quake. Eruption revisited $3,000 March 2020 as lockdowns minted 10 trillion. Fresh central banks reversed to buyers. The GFC trap? Cuts bred bubbles, hikes trap liquidity, gold revalued as fiat's foil, 55% YTD now pales against 2008 to 2020's 400% money print. Now, palladium's 2020 spike, gold's shadowy twin in industrial monetary duality. Stage 1, 1,990 seconds boredom at $300 ounce, byproduct of nickel mining, ignored amid platinum's crown. Expansion ignited early 2000s. Emissions regs crowned palladium catalytic king. Demand doubled to 10 million ounces yearly, while Russia, 40% supplier, mined inelastic. Deficits yawned 8 years straight. Inventories vaporized. Stage 3 recognition crushed 2019. Trade wars. EV shift nipping but diesel mandates surging. Physical premiums hit 20% over spot. Russia delayed exports. COMEX-like squeezes flickered. Stage 4 detonated 2020. From $500 2016, low to 3,000 peak, a six-fold blaze as automakers begged substitutions at 30% efficiency hits. Paper futures? Routed. Shorts margin called billions. Physical stackers cashed 7 figures. Traps twist. Fed's zero rates flooded commodities, but palladium's industrial choke amplified gold's monetary bid. Undervaluation mirrored palladium crashed 50% post-peak, yet deficits persisted, foreshadowing gold's current coil. 3 infernos, 1 forge. Complacency coils, expansion erodes, break exposes, eruption enriches physical faithful. Gold's $4,220 today echoes these scars, undervalued against the Fed's fresh trap. JPM's surge siren blaring the breakout. Layering this pattern onto gold's $4,220 perch amid JPM's $5,000 thunderclap and the Fed's hawkish snare reveals a convergence more potent than any prior quake, monetary trap entwined with fiscal abyss, central bank frenzy, and yield starvation that's turning undervaluation into a powder keg. We're entrenched in Stage 3's vice, the break where illusions of infinite fiat shatter against gold's finite gleam, and today's rate trim with its inflationary asterisk is the fulcrum prying it wider. Peel back the Fed's move. That 0.25% cut, third since September, docks the funds rate to 3.5 to 3.75%, but Powell's presser dripped caution core PCE at 2.8%, not a foregone conclusion for more easing, signaling a 2026 path of just 2 quarter-point slices, not the 4 markets hungered for. The trap snaps. Cuts weaken the dollar to 99. 2. 7% YTD evisceration. 5-week trough, luring yield hunters to treasuries. But hawkish hints rebound 10-year yields half a point to 3.8%. Crimping gold's non-yield allure momentarily. Yet the math betrays the rhetoric. Real yields flirt negative post-cut. Dollars DXY at multi-year lows versus euro and yuan, igniting safe haven bids. Gold's 55% YTD roar, fueled by this volatility trap, easing sparks surge, pause, purges, rinse, repeat, leaving $4,220 a steal against $350 trillion global debt. M2, up 40% since 2020. JPMorgan nails it. Their Q4 2026 $5,000 call, averaging $4,753 yearly. Banks on 566 tons, quarterly investor grabs plus central hoards hitting 800 tons. China alone added 300 tons. YTD, Russia 200. Emerging markets ditching dollar reserves at 20% clip. Undervaluation glares. Gold's market cap at 13 trillion lags Bitcoin's 1.5 trillion froth. Yet backs no hyperbole, pure physics. 200,000 tons above ground. Mining capped at 3,500 tons yearly as grades plummet 30% decade over decade. COMEX whispers the squeeze. Eligible stocks at 500 million ounces, but registered deliverable under 10 million, a 25% YTD drain as lease rates tick to 2%. Backwardation teasing with spot premiums edging futures 10 cents. ETF inflows, GLD up 300 tons quarterly, rivaling 2020, while physical premiums climb $2 to $3 over spot. Dealers like Kitco logging wait lists. Geopolitics oils the fire. Taiwan tensions spike 20% safe haven premiums. Middle East flares reroute 10% oil. BRICS summits plotting gold clauses in trade pacts, 20% reserves, shifting from dollars by 2027 per IMF whispers. The Fed trap amplifies. Post-cut dollar weakness floods EM carry trades, but inflation's rebound core, CPI ticking 3.2% forces hikes, trapping liquidity and catapulting gold as inflation's scourge. JPM's warning? Not isolated. Goldman echoes $4,900 end 2026. UBS $4,500 mid-year. Deutsche $4,450. All citing fiscal cliffs. U.S. Debt service hitting $2 trillion yearly by 2027. 130% GDP ratio unsustainable sans monetization. Industrial undercurrent, subtler than silver's solar guzzle, but gold's bite in electronics, dentistry, aerospace, 5% demand ticks up, with AI chip purity needs, no sub-viable. Central banks? The real squeeze. 2025 buys at 1,200 tons shatter records, up 20%, as RMB internationalization demands 500 tons gold backing. Undervaluation quantifies versus 1,980 inflation peak. Gold's $850 equates 2,500 a days, yet at 4,220, it's coiled. 70% below fair value per JPM's model, blending real yields, debt, and geopolitics. The trap's genius? Fed cuts lure complacency. Hawkish pivot traps yields higher short term, but long debasement 350 trillion debt guarantees deeper easing, dollar erosion, gold reflation. Stage 3's break is palpable. COMEX delivery strains, ETF AUM swelling 15% YTD, sovereign sales nil as buyers dominate. Today's cut? Sparked the $4,220 lunge, but the panic undertow dollar at 99. Inflation lurking propels us toward 4's maw. History's echoes, Nixon's shock, GFC liquidity pale. This convergence of trap, hoard, and havoc undervalues gold profoundly at current quotes. Stage 4's eruption under the Fed trap isn't a maybe, it's the pattern's inexorable punchline, where gold's $4,220 undervaluation morphs into JPM's $5,000 surge, then potentially $6,000 by 2028, as monetary snares and fiscal fissures detonate the yellow metal's revaluation. Picture the cascade. First, a sovereign bombshell. China unveils 500-ton quarterly buys. BRICS formalizes gold clauses. Spiking COMEX demands 50% as ETFs bleed paper for physical. Yields, trapped by hawkish Fed pauses, yo-yo. Post-cut negatives lure inflows, but inflation's 3.2% core rebound forces taper whispers. Dollar dips further to 95, igniting 20% gold bid from EM escapes. JPM's math, 566 tons investor quarterly in 2026. plus 800 tons central, outstrips 3,500-ton mine output. Inventories already strained at 50,000 tons above ground buffer evaporate in months. Prices gap, not grind, from 4,220 to 4,500 inches, Q1 2026 on cut momentum, then 5,000 Q4 as trap bites, inflation forces emergency easing, real yields crater minus 1%, gold's opportunity cost vanishes. Cascade accelerates, COMEX halts like 2020's volatility curves become norm, delivery fails at 20% claims rate, premiums balloon 20 to 40%, spot 5,000 means 6,500 physical eagles, mints like Perth backlogged years. Lawsuits swarm as GLD's cash settle prospectus bites holders, shorts hedge funds, banks margin called 100 billion in unwind. The trap's poetry. Fed's hawkish cut today lulls to complacency, but debt service, $2 trillion yearly by 2027. Demands printing, inflation spirals 4%, deeper cuts ensue. Dollar hegemony phrase, BRICS 30% trade, gold settled by 2028. Counter the skeptics ruthlessly, yields rise, gold falls. Trap flips it post-pause, easing floods liquidity. Yields plunge anew as 2011's 1,900 peak proved. Central banks sell. Reversal etched, net buys since 2010, 2025's 1,000, 200 tons shatter norms, no reversal sans deflation delusion. Substitution in industry? Gold's 5% demand, jewelry 50%, investment 40%, monetary dominant, even tech's purity unmatched, recycling at 30% tops. Mining ramps supply? Geology scoffs, new projects 10 to 15 years gestation, capex starved post 2011, output flat at 3,000, 500 tons despite $50 surge. Demand destruction? Impossible geopolitics mandates hordes, fiscal cliffs, force hedges, policy like IRA subsidies embed gold in green tech. This time's venom, 1,971's fiat birth meets 2008's QE infinity, but 2025's debt supernova, 350 trillion. 10% global GDP servicing traps the Fed in checkmate. Cuts beget inflation, beget more cuts. Gold revalues as the scarce anchor. JPM's $5,000 isn't ceiling. Their 2028 6,000 whispers the floor if BRICS accelerates. Undervaluation at 4,220. 40% below inflation fare, 7,000 per historical models. 70% shy multi-year horizons. The eruption gaps at 5,000 Q4 2026 cascade to 5,500 mid-2027 as trap exhausts fiat faith. Not if, but velocity. Math decrees supply bows to demand's roar in bufferless vaults. With Stage 4's detonation primed by the Fed's trap and JPM's surge siren, gold's $4,220 undervaluation demands action, not frenzy, but fortified positioning to capture the wealth whirl from fiat's fall. First, anchor in physical sovereignty. Shun ETFs, cash traps, and futures leverage pitfalls that vaporize 2011 specs. Opt American Gold Eagles, Canadian Maple Leafs, or 1 kilo Perth bars government minted. Assay stamped for instant liquidity worldwide, premiums 1 to 2% over spot today, but your shield when they spike. Source from audited dealers like APMEX or JM Bullion, verifying serials to dodge counterfeits lurking in panic. Second, seize the moment physical trades $10 to $20 over spot now, but Stage 3's squeeze will inflate to 100, 200 as COMEX strains, with Fed cuts luring but trap pausing. Buy dips under 4,000, 200, scaling in 10% chunks to average the volatility the pattern thrives on. Third, calibrate allocation wisely. 10 to 15% portfolio for most enough to weather fiat erosion, gold's historical one. 0 to 1 outperformance in traps like 1971, scaling to 20% if debt alarms toll louder, but diversify with silver's volatility kicker or treasury's yield buffer to blunt surprises. This hedges the math without betting the farm. Fourth, secure custody unyieldingly. Home safes for tranches under 10 ounces, fireproof, bolted, insured or allocated private vaults like Delaware Depository for scale, keys in your hand, no counterparty creeping in via bank boxes or custodian fine print. Audit annually, diversify locations against seizure risks in trap escalations. Fifth, empower with vigilance track. COMEX eligible weekly, JPM updates quarterly, Fed dot plots monthly. Tools like Kitco alerts or Bloomberg terminals arm you against noise, verifying the pattern's pulse to time without chasing shadows. The Fed trap's genius is its duality cuts beckon buys, hawkish rebukes test resolve, but gold's undervaluation endures, JPM's $5,000 the beacon through fog. Choice crystallizes. Embrace physical now, thrive in eruption's gale, or spectate the transfer, regretting inaction as 5,000 spot mocks yesterday's hesitation. Every cycle favors the forewarned. This one's no exception. If gold's whisper at 4,220 resonates as roar in your gut, subscribe. I'll dissect the breakout beats in real time, from COMEX cracks to BRICS maneuvers. Comment below, $5,000 by 2026, or does the trap delay it? Your insights sharpen the edge. And tune in next. The veiled hand suppressing gold for decades, fines paid, shorts stacked, the playbook exposed. The trap sprung, position or perish.